All righty. Well, we are a couple minutes after 10 here, so we will go ahead and get started. Good morning, everyone. Thank you for joining our first workshop of 2026 to talk about everybody's favorite topic, and that is taxes. For those of you who don't know me, my name is Matt Lage. I've been with Busey for about 5 years now. I'm a wealth advisor on Taylor Morgan's team here in the Bloomington Normal area. Speaking of that, for those of us in the central Illinois area who woke up to a fresh coating of snow this morning, you won't have to look at it for long because the high is 68 tomorrow. So we're getting the full Midwest experience this week. Joining us today, as you see, is Kathleen Edgecombe, who is not only the head of our tax team, but is also the leader of our financial planning team here at Busey as well. She's going to talk a little bit about some of the recent changes brought on by the One Big Beautiful Bill Act. Kathleen is a wealth of knowledge in this space and does a really great job simplifying a lot of these tax concepts that can be otherwise very complex. Before I kick it over to Kathleen to introduce herself and get started, I just wanted to remind everybody that there is a chat feature down at the bottom of your screen there. If you have any questions that pop up throughout the presentation, feel free to type them in there. I'll monitor that chat box throughout, and then we should have some time at the end for Kathleen to answer some of those questions. So again, Kathleen, the floor is yours, and let's go ahead and get started.
Thanks, Matt. Good morning, everyone. Really appreciate you signing in today and participating in this call. I'm going to share my screen here, just make sure it's working. And Matt, can you see the screen now?
Yep, we're all good.
Okay, good, because I can't tell if it's shared. I am Kathleen Edgecombe. As Matt said, I work with both the tax and financial planning teams here at Busey Wealth Management, and those two teams together form what we call is our resource team. I'm a certified financial planner practitioner and a CPA. I have been with Busey for 30 years now. And for some of you, I may look a little bit familiar, but the name isn't clicking. I used to be Kathleen Moore. And as Busey was starting the relationship that we have with the Goldtimers group, I have presented before to this group. So I may look or sound a little bit familiar, just the name didn't click. But that's me. And with the experience that I have, not only with Busey, but in my prior career places, I've really grown to see how important tax and financial planning are together in helping to secure financial future. And tax can be extremely complicated. And some of the things that I'm going to talk about today, you may have heard about, you may know something about, and hopefully I will be able to shed a little bit more light on some of these items for you, because every time there is new tax legislation, it kind of throws people into a tizzy, and it's like, oh, how is this going to impact me? What does this mean? What should I do? Should I do anything differently? So we are going to try to hit some of those highlights, if you will, and break them down a little bit more for you. But before we jump into the actual presentation, I just want to remind you that this material has been prepared for informational purposes only and is not intended to provide tax advice. You should always consult your own tax preparer and tax advisor with regard to your personal situation. And in the context of this presentation today, I cannot address any questions specific to your situation. So now that I've pleased the compliance people by putting that out there, we're going to get in and we're going to talk about the One Big Beautiful Bill Act. And it hits multiple years in multiple ways. Of course, there were a lot of pieces of this legislation that are not directly impacting individual taxpayers, so we're going to leave those off to the side. But understanding the major components of this tax legislation and how it relates to your particular tax situation is going to be critical. So let's see if I can make this go now. Go. There we go. So that was our introduction and our overview. So just a few key things to talk about. The tax rate was set to revert to 39.7% for the upper income level. That has been struck, and we are now staying at 37% as the top marginal tax bracket for the federal tax system. And personal tax exemptions were permanently eliminated. And I say permanently, that's as permanent as any tax law is. I'm old enough to remember what happened with the Tax Reform Act of '86, which was pretty sweeping. And there were changes in that directly impacted a lot of investors. The rules, if you were changed in the middle of the game. So nothing is ever permanent in the tax world, but as permanent as it's going to be, personal exemptions are gone. There were some changes, the introduction of the senior bonus deduction. We're going to talk about that. The child tax credit was automatically increased last year and now indexes automatically for inflation, which is an important change. One of the things that really is kind of startling is some of the changes to charitable gifting and other incentives. The clean energy incentives were basically eliminated for individual taxpayers as of the end of 2025. The deduction for the credit for a purchase of an electric vehicle is now gone. There were enhancements to opportunity zone options for those of you that are investing in those or considering those, and a lot of rules around charitable contributions, which we're going to talk about quite extensively because that is something that impacts a lot of individual taxpayers. And then we're going to also talk about the planning implications of these things. These are going to really require you to reassess your tax filing, your estate planning, and very importantly, your philanthropic strategies for 2025. And I know 2025, that boat has sailed, but there are impacts to 2025 that I want to make sure that you are aware of as you are going into that time of the year where you will be getting your tax returns prepared. So it's really important. And then we're going to talk about the things, how they phase in, how they phase out, and also some of the sunset timelines there. So let's get into and talk about 2025. Even though it is behind us, some of the provisions from the One Big Beautiful Bill Act are retroactive to January of 2025. And so they do need to be considered. You need to be aware of them as you are moving into getting your tax return prepared. The key is to know what to look for, being educated, and maybe you don't understand all the implications, but at least be able to ask the question of your tax preparer. And it's very interesting. I read somewhere in regard to this that the person that wrote the article said that your tax software should know what to do and how to make sure that you're taking advantage of some of these things that are retroactive to 2025. As a preparer, I can tell you, I do not believe it is appropriate to expect that your tax software will automatically apply all the things that you should be entitled to. And you should be able to question and say, okay, wait a minute, does that sound right? I know when I was preparing tax projections toward the end of the year and the software had been updated to reflect some of the changes that we're going to talk about. And I was working on this one and I said, well, that's not right. That's not right. Well, in this case, the software was correct, but I did have the presence of mind to say, wait a minute, that's not what I thought it should be. And so that's one of the things that I would just encourage you to really have a grasp on some of these things to then think about before your taxes are prepared. Is this really going to impact me? And what does that mean? So the key changes for 2025 filings. First and foremost, we all heard about Social Security and the benefits were not going to be taxed anymore. Well, that's not exactly right. And of course, leave it to the tax law to make it a little bit more complicated. What there is now is the senior bonus deduction. And that's an additional $6,000 deduction, excuse me, that you may, excuse me, may be eligible for if you're at least 65 years old. And if you are married, filing a joint return, and both of you are at least 65 years old, you have the potential to have a $12,000 additional deduction. This is in addition to the standard deduction, and it is in addition to the deduction that was already there if you were 65 or blind. Of course, it comes with a new schedule. Somebody asked me the other day, what happened to that postcard size tax return that we were supposed to be filing? Well, that didn't happen. And now we have a new schedule to reflect some of these additional changes. So the senior bonus deduction is now going to be reflected on Schedule 1A. And so you can be on the lookout for that as you're getting your returns prepared. You will notice that now the standard deduction doesn't even appear until the second page of the tax return. Talking with my colleagues here at Busey on the tax side, we've all looked at this new form and kind of scratched our head, and you have to look at it a couple times to make sure that you know what goes where and where to expect it. But so we have this new Schedule 1A, which is where the senior bonus deduction comes into play. Of course, there is an income phase out, meaning if your modified adjusted gross income is over $75,000 if you're single, $150,000 if you're married filing jointly, you're going to start to see that deduction phase out. So that's something to look at. And of course, this is not permanent. This is scheduled to sunset at the end of 2028. So again, more changes to come. We don't know, but this is a big one for 2025 filers. The child tax credit was increased to $2,200 per child. It's indexed for inflation, and we do not see a phase out on that. A new thing that has come back for those of you that have been around for a while, like I have. I remember when interest was a deductible item, if you had credit card interest, car loan interest, those types of things. Well, car loan interest deduction has made a comeback. And it's interesting to see this is applicable to 2025, and you could have the potential deduction of up to $10,000 for U.S. assembled vehicles. Now, there are a lot of criteria that the vehicle has to meet in order for that to qualify. There is a purchase time frame in which the car had to have been purchased in order to qualify this. And again, there are phase outs based on income. You can find the criteria specific if you bought a new car in 2025 and you financed it. Go to irs.gov and you can find the criteria to determine whether or not the interest that you're paying on that car loan is deductible for you. This is also on that new Schedule 1A, and it also sunsets at the end of 2028. So I hope you're getting a feeling right now of how this is all over the board. It passed in July of 2025. Some things were retroactive to the beginning of the year. Some things we're going to talk about don't come into play until this year. Some things in 2027. We've got things that are sunsetting. And so really staying on top of this to make sure that you get all the tax advantages that you can is going to be, as I would say, a full-time job, because that's what my team does. We work on taxes all year round. And not many people smile when they're talking about taxes. Clean energy credits. Those are now basically a thing of the past. There was a vehicle credit that if you purchased your electric vehicle prior to September 30 of last year, you still had the potential to get that credit. If you had energy improvements to your home, as long as they were completed and paid by the end of last year, you have that credit. Otherwise, those are gone and not on the books for the future. Doesn't mean that they won't come back. So we'll see what happens there. And between all of these things, the senior bonus deduction, or the no tax on Social Security, as it was touted, and the SALT cap increase, those are probably the two that people have had the most questions about and have been most interested in. The SALT cap, state and local taxes, which prior to enactment of this law had been limited to $10,000. So if your state taxes and your real estate taxes exceeded $10,000, you were only allowed to deduct up to $10,000. And that's only if you itemized. Well, they increased that limit to $40,000. So what that means is there are probably going to be more people who are now able to itemize. And in the past, if you did not itemize, and now you have maybe $20,000 or $30,000 worth of state and local taxes that you pay, you may be able to itemize. And what that means is then you need to be combing through your records to look for charitable contributions to make sure that those are on there. Because a lot of times if you can't itemize, I know people have just said, well, I know I can't itemize. I'm not going to turn in all my receipts and list that for you. Well, we're encouraging our clients to make sure they do go through their records now, because with the increase of the SALT cap, more of our clients are going to be able to itemize starting this year. So this is an important thing to look at and take notice of. Again, it's subject to a phase out when your modified adjusted gross income hits $500,000. Now, the good news is if you are one of those people that have that very high income level, your SALT deduction will not go below $10,000. So that is something that even if you can't take advantage of the full 40, you're not going to lose any ground with the increase. So those are some of the key things that people have heard probably the most about and are the most interested in. But one of the things that I think has been slightly overlooked is how this impacts your philanthropic endeavors, giving to charity, how much you're going to be able to deduct, what you may lose as a result of some of these law pieces of this legislation. So in 2026, now 2025 was not impacted, but you may find that you are able to itemize, and those charitable deductions that you were thinking that you just made because it was important to you, they may be able to help you itemize in 2025 because of that SALT cap increase. But in 2026, what we have is a new above the line deduction if you do not itemize. This is up to $1,000 or $2,000 if you file married filing jointly for cash only gifts. So even with the SALT cap increase, if you're still not able to itemize, you will have the ability for tax year 2026 to take an above the line deduction for $1,000 or $2,000, but it has to be based on cash only contributions. So your contributions of things that you're clearing out of the house that you take to Goodwill will not count for this above the line deduction. New for 2026 is an adjusted gross income floor for itemized regarding charitable contributions. And what this means is there's now a threshold that you have to clear before you can deduct $1 of your charitable gifts if you itemize. The floor is 0.5% of your adjusted gross income. And while that may not translate to a lot of money, what it means is that you're not going to get a deduction for every dollar that you contribute to charity. So one of the things we're going to do as we go through this is talk a little bit more about maybe some planning strategies that can help with this. In 2027, there is a new credit, a scholarship charity credit, which would allow you to take up to $1,700 of a non-refundable credit. And a credit is, of course, more valuable than a deduction. This new credit that comes into play again next year, 2027, gives you that credit if you make a contribution to a scholarship granting organization. And I'm sure that there will be more released about those qualified organizations so that you would know who you could make that donation to and qualify for that credit. In Illinois, along those lines, we have the Illinois Gives credit, which is a 25% income tax credit for contributions made to permanent endowment funds that are held by qualified community foundations. And you can get more information about that at tax.illinois.gov/program/Illinois Gives, or you can just Google Illinois Gives and it will get you to the information there. But that is specific to your Illinois return. And it's something that I think a lot of people overlook is there are ways to even get more benefits on your Illinois side because your itemized deductions do not impact your Illinois income tax. So that's something the Illinois Gives credit is something specific to Illinois that you may want to take a look at. The other thing that does tie into charitable giving and also proper financial and estate planning is the estate tax exemption. It is now, at the beginning of this year, $15 million per individual, $30 million per married individual. And one thing to remember is that that federal estate tax exemption is portable, meaning if you are married filing jointly and one of you dies, if the deceased does not use the full 15 million, if the proper forms are filed, of course, then the balance of that unused credit will flow over to the surviving spouse. And sometimes that can be very important because as time goes on, and especially with what we're seeing now, investments have grown quite tremendously. And while you may not think that that additional credit would be something that a surviving spouse could use, it could become very important. Illinois, on the other hand, is still $4 million. It is not indexed for inflation, and it has been at $4 million for quite some time and not expected to change based on anything that I'm aware of at this time. Qualified charitable distributions really did not change, but it still works out to be one of the best options for charitable giving if you're over 70 and a half. You do have to be 70 and a half. You do not have to be taking distributions from your IRA in order to utilize this benefit. In 2026, the number is $111,000. And I would point out that the qualified charitable distributions can only be done from an IRA. So if you still have money in a 401k and you want to do a qualified charitable distribution, you cannot do it from the 401k. The money must be in an IRA. And this planning tool has a lot of benefits. It helps with income smoothing, which can help as you're looking at future RMDs, required minimum distributions. It can help reduce the potential of an IRMA-related addition to your monthly Medicare premium, which is very important at this time. The qualified charitable distributions are also great because they're flexible. You don't have to do the same amount every year. You can do it based on how the IRA has grown, what your charitable intent is. If there is a new organization that you feel very passionate about that you have not donated to in the past, you've got a lot of flexibility there. You don't have to itemize your tax deductions in order to get tax relief based on using a qualified charitable deduction. And because it keeps the income off your tax return, it could mean that you pay less tax on your Social Security benefits. Because as we've said, Social Security benefits are still taxable under the same strategy that they were before. There's just the potential for that additional senior bonus deduction. So, how do we plan for 2026? Because we're still at the beginning of the year, so you've got a lot of time to consider what you're going to do this year And then we also need to think about beyond 2026, because as I said, there are provisions that are coming into play in 2027. There are things that are going to be sunsetting in 2028 and 2029. So really getting your hands around this whole thing and understanding the timelines so that you can work with your tax advisor, you can work with your investment advisor to come up with a strategy so that you are really making the most of your money, paying the least amount of taxes, and making sure that the money is doing the things that you want it to do. You've spent a lot of time building your wealth. So now is how do we protect it from taxes and get it to do the things that we need it and we want it to do for us. So start planning now for 2026. As I said, we're a couple of months into the year, but that's okay. There's still plenty of time in which to think about the strategies that are going to work best for you. So first of all, you need to know your situation. Will the increased SALT cap help you itemize? As I said, there are going to be more people this year able to itemize because of that. And taking that into consideration now, as you get ready to go into this year, is going to be important. So if you think you're going to be able to itemize, then how do you maximize that impact? Maybe you bunch your charitable contributions, meaning you pull more from what you would normally give in 2027, you pull it into 2026 so you can itemize. You can consider a donor advised fund where you make a large contribution to a donor advised fund, and that gives you time to then figure out who you want that money to go to. Oftentimes, this is a strategy that we see people use when they have come into money that they really didn't expect, and it's going to impact their tax situation. By making that large donation to a donor advised fund, they can get the tax benefit this year, help offset maybe some taxable income that is coming in this year, but they're not going to have to rush to figure out which organizations to give that money to. And once a donor advised fund is established, you can continue to add to it. You can make distributions from it each year. So it's really a great planning strategy for those of you that have a very strong philanthropic intent. Also, using the qualified charitable distribution to keep your modified adjusted gross income down so that you have a lower threshold for some of these other things that are income driven. If you don't want to lose the senior bonus deduction, are there ways that you can get that modified adjusted gross income down? Well, if you're already taking distributions from your IRA because you're required to, maybe you use some of that qualified charitable distribution idea to help get that income off your tax return. We talk a lot to our clients about smoothing out their income. And this is something that is really important during your retirement years. Number one, you want to know where your income is coming from. And number two, how do you keep from paying more in taxes? So smoothing out your income, tax loss harvesting, I know that's something that Busey does within our portfolios to help benefit our clients, especially when there has been a really big year. I can tell you with the way the market has performed the last few years, it's getting harder to find things to sell at a loss to do the tax loss harvesting. But if it's something that makes sense in your situation and could help offset otherwise big gains, it's something to consider. And that can help avoid big spikes in your income, which is really important as you consider the IRMA impact to your Medicare premiums. If you had big capital gains in a particular year, in a couple of years, that could mean that you're going to pay higher Medicare premiums, not just because Medicare premiums have gone up, because of that Medicare additional IRMA premium. So again, smoothing out your income can help smooth out some of those projected expenses as well. One of the things that I talk to clients about a lot in terms of smoothing out income is taking from qualified retirement accounts now, even if you're not required to. rather than selling pieces of your taxable portfolio and potentially generating capital gains, does it make sense to replace some of that income with distributions from your qualified accounts? And keeping in mind that Illinois does not tax those distributions from qualified retirement income accounts. So that could be an IRA, could be your 401k, it could be a SEP IRA, whatever it is. Illinois doesn't tax that. But Illinois does tax capital gains. Illinois does tax dividends. Illinois does tax interest income. So keeping that in mind, sometimes it makes sense to take from qualified retirement accounts before you're required to. Because by doing that, you also are potentially reducing what you might be required to in the future under the required minimum distribution piece of taxes. And it also gives you the ability to control where you're pulling your money from and minimizing potentially your total income tax. So take a look at that. A lot of people say, I'm not going to look at that money until I'm required to, which for many of us now is 73. And deferring that may not be your best overall plan. It's easy to get sucked into looking at just current taxes, but that's why I'm saying looking at all of these things in conjunction and looking at the longer term piece is really important to make sure that you are minimizing taxes, not just today, but over the long haul. One of the things that we are also talking to our clients about right now as we are preparing taxes and doing projections for 2026 is adjusting any withholding that you have taken out, whether it be from Social Security or potentially other money coming from IRAs, pensions, those types of things. You want to make sure that you adjust if you are eligible to take that bonus, the senior bonus deduction, because that means your taxes are going to be lower. You don't want to be in a situation, or you shouldn't want to be in a situation, I should say, where you're getting a large refund at the end of the year. Most people will make better decisions with their money throughout the year than the federal government or the state government for that matter. Looking at whether or not you're going to be able to itemize. And if you're not, does bunching or making a contribution to a donor advised fund make sense to help you itemize in a particular year? Using the qualified charitable distribution to meet all or part of your required minimum distribution. A lot of clients that we work with don't necessarily need all the money that they are required to take out of a retirement plan. So using that qualified charitable distribution to meet part of that RMD requirement is really key. And as you're thinking about these things, keep in mind oh dear, it looks like I lost a slide. Oh, wanted to talk about the 0.5% deduction for charitable contributions. There's a new threshold this year. I don't know where I lost that, but yeah, if you itemize your charitable deductions, there is now a threshold starting in 2026. You have to get over that 0.5% threshold before you can deduct $1. So that's where bunching your itemized deductions so that maybe you're only getting over the threshold every other year, doing the donor advised fund. So again, you're getting over that threshold in a particular year so that you are making the most of the tax benefits of your charitable contributions. The other thing that is important to realize starting in 2026 is that if you're in the 37% tax bracket, you are going to lose part of your itemized deductions in total. So again, understanding where you are with all of these things and taking a good long look at your situation. And this is the perfect time to do it. If you are going to be able to itemize, if you are going to be in the 37% tax bracket, how do you plan for that? And with our clients, what we do is we prepare a projection for the coming year. at the time that we are preparing the prior year's returns. And so taking a look at what happened in 2025, understanding all of these things that are going to occur in 2026 and beyond, and how that impacts your projection for 2020 and possibly going forward. So again, things to be mindful of for 2025. Make sure that if you're eligible, you do get that senior bonus deduction. Don't depend on the software to get that in there for you. If you did have things that qualify for the clean energy credits, make sure you take them, because 2025 was the last year that we see them, at least at this point. The car loan interest also is really important. If you purchased a new car last year and you financed it, again, you can check the criteria for being able to take that deduction at irs.gov. Question: does the SALT tax increase allow you to itemize this year? Planning your charitable giving, starting to leverage the different options that you're going to have beginning this year, and knowing that you've got that 0.5% threshold. And if you are in that upper income bracket of 37%, that you're going to lose some of your itemized deductions. That's really important. And maybe you can control whether or not you're going to move into that 37% tax bracket. That's really important. And it goes back to the income smoothing as well. The business and high income planning, that is the qualified business income deduction that you may see as a result of some of the investments that you have. I know for clients in the Busey Wealth Management portfolio, we do see that as a deduction on their returns coming from some of those investments. And also the itemized deduction caps for those, your high income level taxpayers. Keeping all these things in mind is really important to plan. And then incorporating the increased estate tax exemption and aligning your philanthropic intent with all of these things is really important. And so there are a lot of changes. A lot of it stayed the same. But the key is to be cognizant of these things and have these conversations with your advisors so that you know that you are getting the most out of your finances. And if we've had any questions come in, I'm happy to take those now, Matt. And if you don't have any questions right now, but you think of something later, you can always reach out to the team at goldtimers@busey.com.
Thank you, Kathleen. You must have explained everything perfectly, because there are no questions at the moment. So again, feel free to reach out to that goldtimers@busey.com. That can also be found on busey.com/goldtimers. That website can really be kind of the home that takes you everywhere you need to go in terms of all things Busey and Goldtimers related. Just a couple reminders I wanted to give out here. Again, thank you everyone for joining today. We really appreciate your time. We plan to do a few more of these workshops throughout the year, so stay tuned for that information as it comes out. These are recorded as well, so these will be posted to busey.com/goldtimers. So if by any chance you're busy or you miss one of them, that's a place where you can go and continue to watch that. Another reminder, Busey still does offer a complimentary investment portfolio review. So that's a really good way to take a deep dive into your specific portfolio. And our team analyzes exactly how you're invested and then looks at ways in which maybe you can improve or kind of how you're set up going forward. So again, that's all found through busey.com/goldtimers. And then if there's any other questions or you just really want to sit down and talk to us, we are always happy to sit down and talk. So again, goldtimers@busey.com, reach out to us and we'll be happy to set something up. I think that's all we've got for you today here. So I hope you all have a great rest of your day. Again, the snow won't be out here for much longer, as we've got almost 70 degrees tomorrow. So enjoy it while it's here. But I hope everyone enjoys the rest of their day. Bye-bye.